When people purchase houses, most of them use leverage, which means if you want to buy a house with a market value of $300,000, maybe you put down 20%, which is $60,000. Your initial deposit is your equity at that point, and you owe the other $240,000 to the lender. The lender also has title to the property in case people get behind. If the market value goes up, it all belongs to the homeowner. All that the lender gets is the debit balance paid back plus interest. But you notice if the home value went up $50,000, so would the customer's equity. In this lesson, we're going to look at long stock positions, and we'll start with the concept of leverage, the initial deposit that customers make under Regulation T, sometimes called the Fed call. The good news with excess equity, the bad news when the market values go the wrong way, customers end up with maintenance calls, and then we'll figure how low can the market value go before that starts to happen. When people purchase houses, most of them use leverage, which means if you want to buy a house with a market value of $300,000, maybe you put down 20%, which is $60,000. Your initial deposit is your equity at that point, and you owe the other $240,000 to the lender. The lender also has title to the property in case people get behind. If the market value goes up, it all belongs to the homeowner. All that the lender gets is the debit balance paid back plus interest. But you notice if the home value went up $50,000, so would the customer's equity. Buying stock on margin is similar. We have to make bigger down payments. Typically it's half the market value. But that means if I want to control $50,000 of stock, I only have to put down $25,000 of cash. That's my equity. The other $25,000 is a loan from the broker-dealer. I'll pay that back with interest. But if the market value goes up to $70,000, that increase of $20,000 is all mine. The equity goes up dollar for dollar. So the debit balance is what we owe the broker-dealer. Sometimes it's called DR, debit register. And the difference between the long market value, or just the market value, and what we owe is our equity. Regulation T, that came about under the Securities Exchange Act of 1934. Under Regulation T, the Federal Reserve Board has the power to regulate margin. And it establishes the maximum amount of credit a broker-dealer can extend based on the market value of a stock, and that's typically half. If the customer's equity goes above half, then that excess is called excess equity, and it's credited to something called SMA, which is just a line of credit that the customer could borrow or use to buy more stock. If the equity is below 50%, we call it a restricted account, but there really aren't that many restrictions there. So on an initial position, I want to buy $30,000 of Microsoft on margin, which means I'm using leverage. I'm going to put down a smaller amount, but I'm going to get a bigger return, hopefully. It's worth $30,000. Reg T, or the Fed call, says I have to put down half. Broker-dealer lends me the other half. That's my debit. And that means at the beginning, whatever you put down, just like when you buy a house, whatever you put down is your equity. How are you going to get more equity if the market value of the asset goes up? So let's talk about the good news. I start out with the $15,000 of equity that I put down. And let's see what happens if the market value goes up. If that goes up to $40,000, that's my new long market value. The debit register is still the same, right? They add interest and you pay it by the month, but often people are trading on margin, trying to do it very quickly so that they don't rack up that much in interest charge. But the equity, that's all mine. Stock goes up by 10,000, so does my equity, just like with the house. What can I do with that? Well, now we use Reg T as a gauge to see if there's any excess equity. If the market value is 40,000, half of that would be 20. The other $5,000 is the excess equity. And because of this, we credit that much to SMA, Special Memorandum Account. which means it's a line of credit the customer could access if he or she wanted to. So SMA, I have this excess equity, and now I have it credited to special memorandum account. In the so-called real world, broker-dealers usually use a different term, but there's still a term for this concept where you have excess equity, and then that becomes kind of a high water mark called SMA. You can't always access this because maybe using it would bring your equity down too low, but it's still going to be there for when you could use it. You could either borrow the SMA, and if you do, the broker-dealer will basically add it to your tab, the debit. And like I say, it's a high water mark. If the stock goes down the next day, you're still going to have the same SMA. You may or may not be able to use it when you want to. But you don't have to borrow it at all. But if you wanted to, you could either borrow the money, they'll add it to what you owe, or you could, whatever the amount is, buy twice that amount of new stock. So if the question says there's special memorandum account or excess equity of $3,000, the customer could borrow $3,000, or he could buy $6,000 of new stock. And let's see how that works. So that's a recap of the good news. It's gone up to 40 grand. It started at 30. Therefore, I have this extra $5,000 line of credit that I could use if I wanted. I could just borrow the $5,000. What would that affect? It wouldn't affect the market value of the stock. It would just be added to the debit. How would it affect your equity? It would reduce it. I'm going to have you put $5,000 on my tab. Okay. You can do that because you have excess equity, but we're going to add that to the debit. And then 40 minus 20, the equity would go down to 20,000. Nobody's saying you have to borrow any of it. Maybe you want to borrow 1,000 of it. You don't have to touch it at all, really. But it's there, just like with a house. Nobody's saying because you have equity, you have to open up a home equity line. But you might want to buy more stock. I have SMA of 5,000. Buying power is 2x of your SMA. How would that affect things? We would add $10,000 of stock, and we would add $10,000 to this as well. A lot of folks have a little trouble seeing that at first because I think they're thinking of this as cash. So this $5,000 that you use in any way is borrowed money, and then the broker dealer is going to front you the other $5,000 of borrowed money. So we add 10 to the debit. All right, so I can borrow and they'll just add to the debit, or I can buy up to twice as much stock and then I'll have that much more stock and the full amount will be added to my debit and the equity would actually not change. But that's not then. All right, but what about the bad news? This is where margin accounts get their bad name. This is where we start. I'm going to buy 1,000 shares of Microsoft. I'm going to put down half. My equity is that $15,000. I owe the other $15,000, the debit. And I don't know if they're going to say DR, debit balance. They'll make it clear. But this is why people often don't like margin accounts. And this is why there has to be a margin disclosure statement. And the registered rep has to make sure it's suitable to recommend this to a customer. Because this can happen. It can get a lot worse than this, but here's one bad situation. It went down. What? So my market value is only 18,000, but I still would owe the same 15. You don't want to see these numbers so close together. There's a minimum maintenance on long stock positions of 25%. So my equity is 3,000, but 1/4 of this market value, what would that be? That'd be 4,500. Ooh. So it's not that your market value is too low, it's that your debit is too high. We need you to pay down your debit by that shortfall. That's what we call a maintenance call. You got to do it now. We may be able to get you an extension, but like the margin disclosure says, that's not a right. That's not something to assume. Also, they explained to the customer, if you don't have the money for the maintenance call, which is $1,500, the broker dealer can just start selling stocks, and you don't have any right to choose which ones, because you owe the broker dealer that debit, and now your property isn't worth very much. The broker dealer could also require more than 25%, but because of FINRA or NYSE, the minimum maintenance they can let you go down to is 25%. A lot of broker dealers would use 33.3, and they could even raise it whenever they needed to. But yeah, the customer needs to come up with $1,500. And it doesn't matter what happens tomorrow. Like, well, let's see what happens tomorrow. Maybe it'll recover. No, there's a maintenance call based on what happened today. You need to send in another $1,500. Or we could just start selling stock. Well, let's don't do that. So a test question may say, in many different ways, what we're doing here is calculating how low can that market value go before I start receiving a maintenance call. And as you can see over here, the formula is just to take the debit and divide it by 0.75. So you don't use the market value here. It's based on this number, 24,000, divided by 0.75. Thought I had a calculator, but I happen to know it's 32,000. That's the account at maintenance, meaning below that there would be a margin call or a maintenance call. And then to kind of prove it, or to actually just prove it. If that were the case, the market value, if it had gone down to here, you would have exactly 1/4 as equity. But rather than having to keep playing and adjusting the numbers, you just use that formula. Based on your debit, divided by 0.75. This is how low the market value can go for the account to be exactly at maintenance. Below there, we'd have to have you add money, meaning pay down that debit, because relative to the market value, the debit is too high, what you owe us. You know, just like if you owe too much to credit cards, they might inform you that your credit limit has been decreased, which doesn't do much for your mood that day. Alright, so in this lesson, long stock positions bought on margin, I'm using leverage. Instead of tying up $50,000 of cash, I can get the benefit of that by only tying up $25,000 of cash. All that upside is mine, I just have to pay some interest on the debit. How much do I have to come up with initially? The Fed call, Reg T. The good news, when I have more than that Reg T, that's my excess equity. We saw that we can borrow it or use it to buy twice as much stock. But when things go the wrong way, we receive maintenance calls, and therefore we might want to calculate the account at maintenance. When will the margin calls or maintenance calls begin? I can go down to it could go down to this amount, and I would be right at maintenance, but below, that's when the trouble would start.